Hello everyone, my name is Emily. Last time we looked at what candlesticks are. In this video, we will look in more detail at candlestick patterns. Candlesticks are created by the changes in the price of an instrument. These price movements can be random, but sometimes they form patterns, what we call candlestick patterns. There are various types of candlestick patterns which can be bullish or bearish. The bullish ones show that the price could rise, whereas the bearish ones show that the price may fall. While no pattern works 100%, candlestick patterns represent trends in price movement. Here we will look at some of the candlestick formations and how to read them. One of the things to look at, apart from the colors, is how long the body of the candlestick is. The longer it is, the more buyers or sellers there are. On the other hand, short candlesticks suggest there is little price movement and represent consolidation. If the white candlestick is long, it means the further the close is above the open. This indicates that prices rose sharply from open to close and buyers were aggressive. On the other hand, long dark candlesticks show strong selling pressure. The longer the dark candlestick is, the further the close is below the open, which shows how prices fell sharply from the open and sellers were aggressive. Let's look at some of the candlestick patterns in more detail. A bearish engulfing pattern develops in an uptrend where there are more sellers than buyers. This candlestick appears as a long red real body engulfing a small green real body. The pattern indicates that sellers are back in control and that the price could continue to fall. A bearish engulfing pattern occurs when there are more buyers than sellers. This is shown by a long green real body engulfing a small red real body. With both taking control, the price could rise further. Candlestick patterns can also be blended or merged to form another candlestick. For example, a hammer can be created by blending a bearish engulfing pattern or a piercing pattern. Similarly, a shooting star is created by blending a bearish engulfing pattern or dark cloud cover. Additionally, more than two candlesticks can be blended to create another candlestick. Blending three white soldiers creates a long white candlestick, while blending three black crows creates a long black candlestick. Hope you found this video useful. Stay tuned for more. Bye-bye!
Hello, my name is Christina, and today I will talk about swaps. You've probably heard traders talk about swaps and rollover before, but to understand these forex trading terms, you should first consider what interest is. Each currency has an interest rate connected to it. Since each forex trade involves two different currencies, it also involves two different interest rates. When trading in the forex market, very often, traders may leave their trading positions open overnight. These positions are carried forward automatically the next day, and an interest rate is charged. The interest rate that is charged is determined by the interest rate difference between the two currencies of the pairs which you are holding. Your account is then credited with an interest rate cost called rollover or swap. A swap then arises due to the overnight interest rates for each different currency. By rolling over the position, the trader extends the settlement period by another day. The beginning-end of trading day is considered to be midnight. All positions left open from 11:59 and 45 seconds to 11:59 and 59 seconds will be rolled over to a new value date. As a result, positions are subject to a swap charge or credit. If you open and close position before 11:59 and 45 seconds, you will not be subject to a rollover. Since each currency is borrowed or sold, you can either be receiving or having to pay interest. At the end of a trading day, if a trader entered a long position in a high-yield currency relative to the currency they borrowed, they will receive a certain amount of interest on their account. On the other hand, a trader will need to pay interest if the currency they borrowed has a higher interest rate relative to the currency they bought. The rollover cost is based on the interest rate difference between the two currencies. Let's say the interest rate in the EU and USA are 4.75% and 1% per year, respectively. As we noted, every currency trade involves borrowing one currency to buy another. If you have a buy position of 1 point lot in Euro USD, then you earn 4.75% on your euros and borrow US dollars at a rate of 1.5% per year. IronFX offers Islamic accounts, known as swap-free accounts, for traders who cannot earn or pay interest due to their religious beliefs.
Okay, hi everyone. Hi. Hi Mason. Hi Hans. Hi Isaiah. Ivor. Hi Kingsley. Hi Patrick. Hi Joash. Annie. Tuan. Dan. Will. William. Williams. William. There's 3 Williams today. Hi. Okay, before I start, I just want to check if everyone can see my screen clearly and if you can hear me clearly. I do still see more and more people joining. So for those who just joined, hi, welcome to our webinar. Hi, Patrick. Everyone can hear me fine, right? And everyone can see my screen fine, right? Okay, cool. Thank you. Hi, Jessie. Welcome back. Hi, Crystal. Welcome back. Hi. Okay, cool. So today's webinar is going to be our multi-time frame analysis. We're just going to go on to different time frames and look at, like, kind of just find some setups, and I'll share my strategy. I mean, I've taken you guys quite a few times already. So by now, some of you, or at least most of you who are regulars here, would have been quite familiar with my strategy, okay? But then again, we can go on different time frames and see what different strategies we can come up with. So my strategy is mostly looking for continuations or playing the pullback, or kind of like, most of the time it's just playing the pullback and continuations, okay? So let's just do a little disclaimer before we start. For those who are new here, I mean, even those who are regulars here, hi, okay, I do still see more and more people joining. Hi, Shahid, welcome to our webinar. Hi, Muhammad, welcome to our webinar. Okay, for those who are, okay, hi, hello. Yeah, for those who are new here, or actually for all of you, just a risk warning that trading Forex or CFDs, especially if it's on margin or leverage, carries significant risk. Morning, Kingsley. Morning, wait, what time is it where you're at? It is 6 p.m. here in Singapore. Okay, right. Okay, while you answer that, let me just go through the disclaimer. carry significant risk and may not be for all investors. So do be cautious if you are new to trading. Even if you're not new to trading, be cautious. You know, discipline is key to everything. And another disclaimer that any information I share in this webinar should not be construed as trading advice. Okay, this is not a hi. This is not a signals guru. This is not a forecasting guru. Okay, this webinar was brought to you by IronFX with the main aim of helping you guys grow your accounts and learn trading the proper way. Okay, so do not take this as trading advice or anything at all. Please take this as educational. Okay, this is an educational webinar. Okay, so if you guys have any questions throughout the webinar, don't be shy, ask in the chat box. Okay, because again, IronFX and like we brought you guys this webinar so that you guys can improve as traders, right? But if you guys are not asking questions, then it's like I don't know what you don't know. Hi. Okay, hi, Idioma or Osta. I'm not sure if I'm pronouncing your name correctly. I just want to find out where you guys from. You have really different names from what I'm used to. And morning, I think most of you should be in Europe, I think, or yeah, most likely Europe, right? It's 6 p.m. here in Singapore. Not sure where you go. Ah, Czech Republic. Nice, nice. I've never been, really want to go. I've been to so many countries, but not Czech Republic. Really want to go. Midday here. Okay. All right. Nigeria. Hello. I love seeing the crowds like from everywhere. I guess Jesse. Okay, for those who are shy, you can just send the message directly to me. You don't have to share to all panelists. Oh, Kingsley from Nigeria, 11 a.m. Nigeria, Shahid, Philippines, Patrick. Hey, I think it's Mabuhay, right? Hi. Okay. I'm so glad to see so many of you here from different countries. Or am I sending this message just to you? I wasn't sure. No. Okay. Jesse has yours is to all panelists, but for those who are shy, you can just direct the message to me. I don't have to read your question out loud. I won't say your name, okay, for those who are shy. Okay, let's do a little introduction. For those who don't already know me, I have taken you guys a few times already. My name is Cassandra. You guys can call me Cass. I am a prop trader and a investment analyst here at Everest Fortune Group. Okay, so Everest Fortune Group, we are an award-winning fintech company based in Singapore. Okay, so we are the finalists for the best forex and best equity research for 2019, 2020, and 2021. Okay, so basically what we do here at Everest Fortune Group, we do a lot of research, back testing, and strategy testing on where we think the markets are going, and we mostly focus on forex pairs. Well, forex pairs, cryptocurrency, we do everything, stocks as well, stocks included, but a lot more to forex and crypto. Okay, we advise banks, brokerages, hedge funds, financial institutions on where we think the markets are heading. Okay, so again, if you guys do have any questions, don't be shy to ask. Okay, we have because today we have a special partnership, and every time we do these webinars for you guys, we have a special partnership with IronFX, right, to bring you guys these webinars. Ultimately, the aim is to help you guys grow as traders and help you grow your account. Like if you guys, we ultimately want you guys to be winning in trading. Okay, so don't be shy, ask any questions you want to. A little bit about me. Okay, my name again, Cass. You guys can call me Cass. In terms of trading, I mean, I've got quite a bit of experiences. I don't think it's like necessary to mention it here, but like focusing on trading, right? I'm personally managing more than, actually it's more than $1 million now, $1 million US on my own personal account. I've been quite profitable for a while. So I've passed FTMO twice and my Forex fund twice. For those who don't know what these are prop trading tests that requires you to be 10% in profit, okay, each time you take the test. So I've passed these tests month after month after month. I'm consistently still profitable. Most months I'm about 2 to 8% in profit. Okay, so I usually make 2 to 8% per profit. And today, whatever I share with you guys today is basically my way of trading. There's many ways of trading out there, right? There are like reversal traders, I don't know, scalpers or whatever. So today it's just my way of trading and how I managed to get that 10% every month, or like 2 to 8% every month on average. Okay, so again, our question: why do you trade with both prop firms? Is it just a bigger account? Okay, so why I trade with different prop firms, okay, is because one prop firm requires you to do 10% to pass, while the other one requires you to do 8% to pass. Okay, so when I was doing my Forex fund, I actually passed my Forex fund, my Forex fund in 5 days. Yes, I made 8% in 5 days. But I was going very aggressive. Okay, so I was just trying different prop firms to see which one is more reliable. Because in case one closes down, for example, at least I still have the other one going. I'm also prop trading at Everest Fortune Group, so I am prop trading at multiple places and multiple firms. But yes, the whole point of me telling you guys is that I do have a strategy that is quite profitable. My strategy focuses on continuations, actually reversals and continuation. Okay, and yeah, I hope you guys learned something from my webinar. Hopefully, I hope you take something useful on my webinar. Okay, so let's just go through our agenda for today. We're gonna go through key approaches we take to trading, the cheat sheet checklist, and then we're gonna move on to multi-time frame analysis. Okay. Okay, so this is basically the checklist that I use when I'm looking for a trade or a setup. I know it looks like it's a lot, but honestly, maybe because I do it so often, usually it only takes me 5 to 10 minutes. Okay, maybe 10 minutes on average, 10 minutes to go through a particular pair, a particular chart to look for a setup. Okay, but this is basically what I go through. Every time I go on the charts, I will ask myself, do I see any horizontal level? Do I see any trend line? Do I see any channels? Do I see any chart patterns, dead cross, golden crosses? Do I see any natural moving averages? Then I pull out my indicators. And then for reversals, do I see all of this? And for breakouts, do I see any of this? So if you guys want to take a screenshot or whatever it is, maybe jot this down somewhere. It is a useful checklist to refer to, right? I'm not saying, okay, sorry, I don't use this for all my trades, but majority of my trades, I use this, okay? And I think it's a very good checklist to refer to. You can come back and just refer to it. Did I look out for this when I'm looking for my analysis? Okay, so that's that. So a lot of my trading focuses very much on, actually here at Everest Fortune Group, we focus a lot on Fibonacci. So Fibonacci confluence, I think, is a very, very powerful and strong tool, okay, to look for setups. Why? Because when you look at the markets, you look at the charts, you kind of see it going in a downtrend. So you have a rough idea that it is a downtrend, right? So you have a rough idea that it is a sell. It is sell. But how do you pinpoint or narrow down exactly where the reversal is going to happen, or your exact entry? That's when you use Fibonacci to narrow it down and kind of like refine your analysis. Okay, so today we're going to be using a lot of Fibonacci as well to refine our analysis. For those who never have never attended my webinar or new here, I'm going to just run through a analogy that I use, right? I'm just going to run through an analogy that I use whenever I'm using Fibonacci. I think it's a very good one. It's a very silly or maybe simple analogy, but I use it, and every time I think of it, okay, that makes sense. I should be using that. So I'll tell you guys when we move on to the charts. For those who are here every week, you guys already know this analogy. Can you explain the basics of Fibonacci starting from point to end point? Okay, I can just quickly run through Fibonacci because today our main focus should be multi-time frame analysis. So I'll just briefly run through Fibonacci. Okay, this is a retracement. Okay, I would need a pen to draw it out for you guys. So later when I move on to the live charts, I will use the pen tool so that I can explain in more detail how to use Fibonacci. But basically, these are some of the Fibonacci. This is the Fibonacci retracement. You pull from the swing high to the swing low, and then you get some of the level you think price is going to retrace. So this is the projection where you're projecting price to go after from the 3 points. Let's move on. This is called, okay, this is called the expansion. Expansion, you are basically looking for negative levels on the Fibonacci, and this is the extension. Kind of looks like a Nike tick. You guys see this? It kind of looks like Nike, you know, the shoe brand, Nike, the running shoe brand. Okay, so it kind of looks like that, and we're gonna go into the live charts. Okay, let's move on to the live charts. Oh, and this is confluence, where we combine all Fibonacci levels to pinpoint exactly where we think is the most probable or most likely place of reversal and reaction on the markets. Okay, thank you for sitting through the introduction. We're gonna go on to the live charts, where I'll just quickly and briefly explain Fibonacci before we go into our main aim today, which is multi-time frame analysis. Okay, just give me a moment to switch to the live charts. Okay, can everyone see my screen? If you guys can see my screen, can you guys just let me know in the chat box so I know that you guys are not just staring at a blank screen. Okay, thank you so much, Jessie. Okay, cool. So I'm just gonna quickly run through Fibonacci so that for those who are new here, you guys, it's easy for you to follow. For those who have heard this so many times already, just bear with us, right? We want to make sure more people can follow. And of course, we want to make sure more people are growing their account, right? If everyone is in profit, we are happy. Okay, so when we're spotting for Fibonacci, ultimately we need to first spot the patterns on the chart. So there's 4 patterns with Fibonacci. This is called the retracement. Oh, sorry. I'm trying to draw a retracement the other way. Okay, yeah, got it. Okay, this is called the extension. How do I draw an inverse one? I can't, I'm trying to imagine it. Okay, there you go. And this is the projection. Okay, let me just explain these in detail, like just briefly. Okay, before you even find Fibonacci, what time frame are we using? Just give me a moment, Patrick. I'll get into that shortly after I do a brief introduction on Fibonacci. Okay, so before you even use Fibonacci, you need to identify the patterns on the chart. So this is called the Fibonacci retracement. This is the first one that you want to identify. If it's there, you have to ask yourself, okay, is there a Fibonacci retracement on the charts? So Fibonacci retracement basically looks like a V. Okay, it looks like a V, but the back end of the V is shorter than the front end. Do you guys see this? Okay, it is shorter than the front. So it can look like this. It can be inverse as well. So it can be like a mirror image of it, like the other way around. Okay, so this is a Fibonacci retracement. Fibonacci extension, it looks like a Nike tick. So Nike, you know, the shoe brand Nike. I'm sure everybody knows Nike, the running shoe brand or basketball, whatever it is. Okay, it looks like a tick. There is one right here. Do you see here? This is a Nike tick. Okay, so this is a Fibonacci extension. It can be inverse. The other one is the Fibonacci expansion, which we have here on the chart. It kind of looks like an N, or it can be inverse. And the other one is Fibonacci projection, also an N pattern or a zigzag pattern, and it can be inverse as well. Okay, so let me explain. Fibonacci retracement has 5 levels. So let's say I spot a Fibonacci retracement on the charts. Okay, I spot a Fibonacci on the charts, Fibonacci retracement. I'm going to go to the Fib retracement tool at the side. I'm going to go from the swing high. I'm going to pull it to the swing low. Okay. I'm going to go into the settings. Okay, and I'm going to remove everything. How do I remove everything? Sorry, excuse me. Okay, I'm going to remove everything and I'm only going to pull out the 5 Fibonacci retracement levels, which is the 23.6, the 38.2, the 50%, the 61.8%, and the 78.6%. Okay, so Fibonacci retracement 5 levels you want to take note of. Okay, Fibonacci extension level from the swing low, you look at for Fibonacci extension. Okay, sorry, 3 levels: 127.2, 138.2, and 161.8. Let me just change this. Okay, 161.8, you're gonna pull it, and then these 3 levels are gonna come out, and these are the 3 levels that you expect price to go to. Okay, for Fibonacci expansion, you are going to pull from the first part of the N pattern or the zigzag pattern to the second part of the zigzag pattern, and then you're going to pull out the 2 negative levels that we look at. So negative 27.2 and negative 61.8. For those who are just learning this for the first time, don't worry, there's no way you can remember everything, especially since I'm only going through it one time. I'm sure we will have a webinar on Fibonacci series, okay, but it's not a hard topic. It's just that there are particular settings and particular level that we take note of. Okay, so it's not so much that it's hard. It's just things that you need to write down, and then you come back and refer to it. When you're using the Fibonacci, you just come back to your notebook or whatever it is to refer to the levels that you're supposed to be using. Okay, so Fibonacci expansion, the 2 levels that we're using are the 2 negative levels. Okay, and Fibonacci projection, the levels that we're using for Fibonacci projection retracement, because you're not taking more, now you're taking 3 points. You take from the swing low to the swing high to the swing low, and then we use it to project levels from 61.8%, 78.6%, and 100%. So these are the 3 levels that we look at for Fibonacci Fibonacci projection. Okay, these are the basically levels. So there's 4 Fibonacci's that we look for. All 4 has different levels that we look for, and all 4 has 4 different patterns that we look for. Okay, so that's just a very brief introduction. I won't be able to spend too much time on Fibonacci. It's a very, very important thing to learn, but I won't be able to spend too much time on it today. Because today our topic is multi-time frame analysis. Okay, so let's just try to stick to the topic today. And next time when there is a Fibonacci class or webinar, you guys can hop on, and then we can do a lot of you can do a lot of practicing with Fibonacci. So I don't think Fibonacci is hard. It's just a lot of practicing. It's just training your eyes to be able to spot the pattern and remembering the levels that you need. So actually, to be honest, if you have a notebook, you just write down the patterns that you should be spotting. You just have to write down the levels that you should be looking at. You should be fine. Trading is not hard. It is the learning part that is hard. Okay. Okay, so let's start with our topic for today, which is multi-time frame analysis. Give me a second, I'll turn this air conditioner off. It's too cold. Okay, can you guys let me know in the chat box which time frame do you guys think is the most important? Can you guys let me know in the chat box? Okay, we have answers coming in already. I've got someone saying 1 hour. Okay, Jesse's saying 1 hour. I've got another person saying 1 hour. Those who are shy to answer to public, you can just send the message directly to me. Okay, so Osta, sorry Osta, I'm pronouncing your last name instead because I'm not very sure how to pronounce your first name. So Osta is saying 4 hours. We've got someone else saying 4 hours. Someone else saying 4 hours. Okay, most of you are saying 4 hours. Kingsley saying 4 hours. Another one of you saying daily. Another one of you saying daily. Another one of you, Shahid, saying 4 hours. Okay. That was a trick question. I'm so sorry. Okay, there is no time frame that is more important or better than another time frame. What time frame we look at depends on what kind of trader you are. So when you look at the time frame, you choose the time frame you want to use, you need to ask yourself, what trader am I? Am I a, so there's three kinds. Am I a scalper? Am I a day trader? Or am I a swing trader? So a scalper is someone who is in and out of the market really, really fast. Okay, so they're in and out with the market really, really fast. Please, can you start with the daily? Yes, we can start with the daily. Just give me a while, Kingsley. Okay, so a scalper is someone who starts with, goes into trade that are very fast. They go in and they come out. So their trade can last from anywhere from 5 minutes, maybe 5 minutes to 10 minutes to 1 hour, 2 hours, 3 hours, 4 hours. Okay, so that is a scalper. We have another kind of trader called a day trader. Their trades usually last for 24 hours. Okay, they usually close out their trade within 24 hours before the day ends. Okay, and the last kind of trader is the swing trader. So swing traders can be people who hold their trades for more than a day, for days, for weeks, or for months. Okay, so these are swing traders. Can you guys let me know in the chat box what kind of trader you are so that we can decide which time frame we're going to look at? Okay, so Jesse's a scalper day trader. We've got someone saying swing trader. King. Oh, okay. There's two Kingsley in the chat. Sorry, I was calling. Okay, so there's Kingsley Emerson saying scalper, day trader, swing trader. Shahid is a swing trader. We've got another swing trader here, another scalper, another day trader. Okay, so I think the crowd is a little mixed today, right? You guys are a bit mixed today. Okay, so let me just break down what kind of time frame you should be looking at. If you are a scalper, you should be looking at the time frame 1 hour and below. So 1 hour, 30 minutes, 15 minutes, 5 minutes, 3 minutes. Okay, that is the time frame you should be looking at. If you are a day trader, you should be looking at the 1 hour and maximally, okay, on the maximum, the 4 hours. Okay, even if you look at the 4 hours, sometimes the trade may last for 2 days. Okay, so that's not really day trading anymore, right? But it's not as long as swing trading. For swing trading, you look at the daily, the weekly, and the monthly. Okay, the daily and the weekly and the monthly. So let me break down to you why these time frames affect the type of trader that you are. Okay, why I am a day trader. I chose to be a day trader because I am a prop trader. I am an analyst. I am an investment analyst, right? I'm a forex analyst. So it is my job to look at the charts every day. This is literally my livelihood. So because I look at the charts every day, it makes sense for me to be a day trader. Why I'm not a scalper? Because sometimes I'm writing reports and I can't really scalp, right? I need to write reports. I still need to look for strategies. I still need to do. So I think day trading is suitable for my lifestyle because I look at the charts every day. I come back to the charts and it complements my lifestyle. It suits my lifestyle. Okay, but let's say you are someone who let me think of an example. You are someone who runs a business. You have 4 kids. You are someone who is super duper busy. Okay, you travel a lot. You're on the plane a lot. You are someone who cannot be in front of the computer so often. You cannot be looking at the charts so often. Okay, you go out a lot and you don't want to be on your phone looking at charts. You can consider being a swing trader. Why? Because swing trader means that you're looking at the daily time frame, the weekly time frame, and monthly time frame. That means you only need to come back and look at the charts maybe every week. You look at it once a week. Maybe you look at it once a month. You look at it once in 2 weeks. You look at it every 3 days, every 5 days, whatever it is. Okay, it's different from day trading because day trading requires you to come back and look at the charts every single day. Every day you need to come back to the charts and see, oh, what's going on today. Okay, swing trading, you can come back every week. Okay, but let's say you are a scalper. You for some reason you are a full-time prop trader. Okay, you are a full-time trader. You just take trades over and over, back to back. You can be a scalper, and in a scalper you can go to the smaller time frames. Okay, and also in scalping, it's for people who want to make very quick trades, you go in and out, go in and out, go in and out. Why I didn't choose to be a scalper is because I feel like scalping is very tiring, right? I like to just look at the charts once a day. I spend maybe half an hour or 1 hour a day on the charts, and then I go live my life. Okay, I don't want to spend too much time on the charts. I don't think it's healthy. But if you are a scalper and you really enjoy it, you really love looking at charts, then yes, you can be and can look at the smaller time frames. Okay, so because I see most of you here are scalpers, day traders. Let me see, scalpers, day traders. We got a few swing traders. We can just break down. Okay, so let me show you what the difference would be if you are making your analysis on different time frames. Okay, so I think earlier on, Kingsley was requesting for me to look at the daily time frame, right? I see your request, Kingsley. Don't worry. Kingsley Israel. Very nice name you have. Okay, to start with the daily time frame. So let's start with the daily time frame. Okay, so there's two things we're going to do now with the daily time frame. If we're looking at the daily time frame, that means we are either we are most likely a swing trader. Okay, a day to swing trader, right? So if you are looking at a daily time frame, you can first use a daily time frame as a reference to go to the 4 hours. Okay, that means you go to the daily time frame to look for information, and then you go for the 4 hours to refine your strategy and refine your analysis to look for an entry, stop loss, and take profit. Or what you can do is go to the weekly to look for information, look for relevant zones, relevant lines, and then go to the daily time frame to look for your analysis and refine your strategy. Okay, so let's just quickly do an analysis on the daily time frame, and then I will show you how it would differ if you were to do an analysis on the 4 hours, for example. Okay, so let's say on the daily time frame. On the daily time frame on BTC USD, we are looking at BTC USD right now. Can you guys let me know in the chat box, do you think BTC USD is going in an uptrend, or do you think it's going in a downtrend? This is a very important question you have to ask yourself when you are looking at the charts. Why? Because this will determine whether you are going in for a buy or a sell. Okay, thank you, Jesse. Anyone else? Thank you, Ismail. Thank you, Emerson. Thank you. The other Kingsley, sorry, I cannot pronounce your first name. Inechukwu. I'm not sure if I'm pronouncing it right, so I think to be safe, I'll just call you Kingsley. And the other Kingsley Israel. Okay. Okay, so everyone is saying it's a downtrend. You are right, because price is making lower highs and lower lows. Okay, so price is definitely moving in a downtrend on the daily time frame. Okay, so let's just try to highlight maybe a channel or a trend line if it's available. Okay, let's try with a channel. Okay, there is a channel. So a valid channel, you will need 2 touches on top and 2 at the bottom. This satisfies our channel. Of course, the more touches, the better, but on the minimally, we need 2 touches on top and 2 touches at the bottom to make it a valid channel. Okay, another thing I might see is an even smaller channel. So there's a big channel here, but there might be a even smaller one. Let me try to see if this smaller one will work. Right. Okay, so there is also a even smaller channel here. So I am going to just leave that. Sorry, give me a moment. Okay, you know what I've noticed? I noticed that price has done a channel breakout on the smaller channel, but remember, it is still moving in a bigger channel. So you know, when we're looking at daily, this could mean 2 things. One is that it is a short-term uptrend. Why is it an uptrend? Because price was moving in this smaller channel, right? Okay, let me just change the color so that you guys know what you guys can, it's clearer for you. Okay, so price is moving this smaller red channel here. It broke out of this channel here, which is indicating bullishness. Okay, anytime there's a breakout of channel or breakout of a zone or breakout of anything. It just means that there is possibility of bullishness. Okay, it could mean that it's a short-term bullishness, but a long-term downtrend. Why? Because on the long term, it is still moving in that big channel, right? On the long term, it is still moving in a bigger channel. On the short term, it has just broken the smaller channel. Okay, so let's just highlight a few support and resistance so that we can kind of roughly get our bias. Because of this break of this channel, I'm not so keen on looking for a sell entry anymore. And maybe we can look for a buy from here to the bigger channel. Okay. Okay, so let's just highlight a few horizontal levels. Okay. Okay, so this is a resistance. I'm going to change the name so it's clear for you guys, and so that when you're doing analysis, charting yourself at home, you guys will know what to look for and whatnot. Okay, so there's two things I much rather do right now. The first thing is that I much rather look for a sell entry. Okay, I can look for a sell entry from here. Why am I looking for a sell entry? Because I think price is still respecting this channel. Or I can look for a buy entry where I go in from here to here. And then from here, I look for that sell to here. Okay, you guys see that? Do you see how from the information you collect on the charts, you are able to come up with a lot of analysis and where you think price is going? So just based on the channels alone, I think there's going to be a bit of some bullish momentum. There might be a bit of bullish momentum. And then when it gets here, there's going to be resistance. Okay, there's going to be resistance. And then I think price is going to reverse from here back to here. Okay, let's use some Fibonacci levels or whatnot to see how accurate my rough analysis is. Okay, for those who've never heard this, let me tell you an analogy. For those who have heard this, because I take you guys I've been taking you guys for a few weeks now. You guys probably heard it. Okay, so this guy's name is Bob. Okay, Bob is walking to the right. Okay, Bob is walking to the right. Okay, he reaches a door. If the door is heavy, it is made out of stone, it is made out of very heavy metal, for example, or the door is locked, for example, Bob will keep pushing the door, and he's going to fail to open the door, and therefore he needs to turn back. Okay, he's going to turn back, and he's going to U-turn and turn back. Okay, if the door is light, it is unlocked, there's nothing behind the door, there's no barrier, he can safely and easily open the door, push it open, and go into the next room, right? Do we all agree with this analogy? Right, so it is similar to price. It is similar to price. Right now, your support and your resistance, okay, let me change this to first support, works as the door. Price is Bob. Anytime price reaches a resistance or a support, it's going to try to push that resistance or support open. Okay, it's going to try to push the door open. If it successfully pushes the door open, it will go higher. Okay, it will break and it will go to the next room. If it doesn't, it will reverse. Okay, it will reverse and it will make a U-turn and it will reverse. Okay, if it doesn't, it will just reverse. So right now, our job as a trader is to first identify where your support resistance is, identify where the door is, so that when price gets there, you need to ask yourself, is price going to break higher or is it going to reverse? Okay, we don't know, is it going to break higher or going to reverse? So how we see if price is going to reverse or break higher, we need to identify the strength of this resistance or this support. We need to identify how strong these levels are. The stronger it is, the harder it is for price to break it, and therefore it will need to reverse. And when it reverses, we get in for, that's when we decide if we get in for a buy or a sell. If it reverses at the first resistance, can you guys let me know in the chat box, do we get in for a buy or a sell? I just want to know if you guys are still following. If price gets the first resistance and the first resistance is a very strong resistance, do you think we should be entering here for a buy or a sell? Okay, thank you, Kingsley. Thank you, Jesse. Thank you, Ismail. Thank you, John. Thank you, William. Thank you, Will. Okay, cool. So right now, most of you say sell. Thank you so much. I'm glad you guys are still following. Okay. It means that if we think it's going to be a sell here, it means that we think this area is a very strong area. We think that this door is very strong and price will have a hard time opening this door and therefore it needs to turn back. Okay, he won't be able to go into the next room, rather to the next zone. Okay, so how do we establish the strength of this resistance or this door? We use Fibonacci again, right? We use Fibonacci. Let's pull out our Fibonacci retracement. We are trying to identify Fibonacci retracement here, which is the V pattern with the shorter end, okay? We're trying to see if there's any Fibonacci retracement that lines up near or on top of our resistance, okay? So from this swing high, I'm gonna pull to the swing low. I'm gonna pull out my 5 Fibonacci retracement levels, okay? Can you guys let me know which Fibonacci retracement level is closest to our first resistance? I'll make it bigger so you guys can see it clearer for those who are watching this from your phone. Okay, thank you, Jesse. The rest? Thank you so much, Osta. Okay, yes, so the 38.2% is the closest level to our first resistance. Therefore, we're going to go into the settings, get rid of every other, thank you, Shahid, every other level that is not the 38.2%, because those levels are not relevant to us, okay? We are only focusing, we are just bringing our focus to the first resistance and the first support. Anything other than the first resistance and the first support, we're not that interested. Why? Because this first support and first resistance will work as our entry, stop loss, and take profit. Okay, so we got 38.2 lining up very nicely. I see an even bigger Fibonacci retracement here. Okay, I see an even bigger Fibonacci retracement here. I see a Fibonacci projection here. Okay, the zigzag pattern. Okay, so let's see if any Fibonacci levels are lining up there. For those who are still confused, don't worry. Fibonacci is not hard. It's just training your eyes to be able to spot. Okay. Okay, so in this case, I see the 28. If I pull out all the 5 levels, the 23.6 will be the closest. So I'm going to only leave the 23.6 level. Then I'm going to get rid of the rest. Let's see the zigzag pattern, if we can find any level that lines up close. Okay, no. Let me see the bigger zigzag pattern, if any levels line up close. Okay, we've got the 78.6. Okay. For the zigzag pattern, which is the Fibonacci projection, these are the 3 levels that we look at. So in this case, the 78.6 is closest to our first resistance. We're going to get rid of everything else, and we're only going to keep it 78.6. Why? We want to keep our charts nice and clean, right? We want to keep our charts nice and clean. Okay, now that I've identified my Fibonacci levels, I'm going to highlight this area. Why? Because actually support and resistance is not one number. Okay, it's never one number. It's actually a zone. It's more like a zone. Okay, so I'm going to highlight this zone. This is our first resistance zone. I'm going to turn it to red so you know that it's resistance. Anytime it's green, it's support. Red means resistance. That means when, okay, so let me go back to my bob. Where is my bob? Okay, there he is. Okay, so what does Fibonacci represents in this analogy? It represents barrier behind the door. Okay, right now you have Bob trying to push this door open. We don't know if the door is going to push open or not, but we know there's a door there. So the door itself is already a form of barrier, right? So Bob already has some kind of resistance before he can go to the next room. Now we have 3 Fibonacci levels lining up in the exact same area or near the first resistance. So what does this Fibonacci represent? It represents 10 kilo rocks behind the door. Okay, it represents 10 kilo rocks. For every Fibonacci levels that lines up near or on top of the first resistance, it represents a 10 kilo rocks. So hey guys, I'm so sorry. So sorry guys, is everyone still with me? Everyone's still with me, so sorry. Okay, everyone can see my screen, everyone can see the charts. Okay, all my messages is gone, so I wouldn't be able to see if you guys messaged me a while ago. So sorry about that. Okay, my internet disconnected for a while. I thought you thought you lost your connection. I'm so sorry, Patrick. It was me. Okay, my internet disconnected for a short while. Okay, is that why you guys weren't responding? I was asking you guys a question and nobody was responding to me. I think my internet got disconnected and I didn't realize. Can you guys let me know what was the last thing you heard? Kilos and rocks. Okay, yes. So the Fibonacci, thank you, Jesse. Thank you, everyone. Thank you, Ismail. Thank you, Kingsley, Shahid, Emerson. Okay, so the Fibonacci levels represent rocks that are behind the door. So in this case, there is a lot of barrier here, don't you think? There is the first resistance there. There is 3 Fibonacci levels lining up here. And on top of that, there is a channel, descending channel, all lining up in this first plate. So my question is, when price gets to this area, do you think price can easily break this area, or do you think it's going to reverse from here? Can you guys let me know in the chat box? When price gets to our first resistance, do you think it is higher chance of a reversal or higher chance of break? Okay, thank you so much. Thank you, Shahid. Thank you, Jesse. Thank you, Joash. Thank you, William. Thank you, Williams. Okay, thank you, Kingsley. Yes, the chances of it reversing is higher, right? I cannot say for sure, right? There is a possible reversal. Thank you, the other Kingsley. I like that you use the word possible. Why? Because our job as a trader is never to be like, oh, okay, price is going to reverse from here. 100%. I am 100% sure that this is a sell. I'm 100% sure. It's never 100%. Our job as a trader is only to find the higher possibility, okay, the higher probability. So when price gets to the first resistance, we have there is a higher chance of reversal than there is of a breakout. Why? Because of all the information that we have collected. Based on the information that we have collected, we think that the possibility of a reversal is higher than of a breakout. So therefore, if price gets here, we are getting in for a sell. We will be looking for a sell entry. Okay. Okay, cool. So let's do this one first, where we're looking for a sell entry, right? We're looking for a sell entry from here, from our first resistance to our first support. Why the first support? Because price is always attracted to key levels. So let's say Bob breaks this door open, he goes into the next room, right? When he goes into the next room, when he reaches that room, there's going to be another door here. When he opens this door, there's going to be another door in the next room. Okay, if he doesn't open the door, he turns back. Behind him, there's another door. Okay, so Bob is basically just in between a lot of doors. Okay, so we think that price is going to reverse from here to here. Now that we have found our analysis based on support resistance, based on trend, and based on Fibonacci levels, we are going to back our analysis up with indicators. That means we need the indicators to agree with us, okay? It's the same thing. I've told you guys this story many times. Let's say you are going to buy a pink dress, okay? You don't know if the pink dress is nice or not. So you ask your mom, hey mom, do you think this pink dress looks good on me? If your mom says yes, it will convince you to buy the pink dress. You ask your dad. If your dad says yes, it will give you even more confidence to buy the pink dress. If you ask your brother, your sister, everybody says yes, then you're definitely getting the pink dress. Why? Because you are confident that you look good in that pink dress and therefore you want to get it. So similarly with looking for trades and setups, now we think it's a sell. We think that it's a sell from the first resistance to the first support. We now need the indicators to confirm our analysis, to support our analysis, to tell us, yes, you are good for the sell. Okay, so when we go into the indicators, remember guys, there are so many technical analysis. Look at this, there's hundreds of technical analysis out there. So which analysis do you use? These are some of the analysis, these are some of the indicators. Did I say analysis? Okay, so there are hundreds of indicators out there. So which indicators do you use? These are some of the indicators that we use here at Average Fortune Group. Why? Because from back testing and strategy testing, we find that these indicators give us quite accurate information. We're not saying that the rest of the indicators are not good. It's just that these are the indicators that we are used to using. Okay, we find that these are good enough. Okay, so we don't really use the others. Okay, okay, so let's pull out Bollinger Band, for example. Let's see what Bollinger Band is saying. Okay, Bollinger Band is not telling us it's a sell. In fact, Bollinger Band is not saying much. If anything, Bollinger Band is not saying much. Why? Because Bollinger Band, we use it as a support and a resistance. Actually, if anything, Bollinger Band is telling us it's a buy. Okay, we're gonna get rid of Bollinger Band. Okay, let's see what the Ichimoku cloud says. Okay, Ichimoku cloud. Give me a moment. Okay, Ichimoku cloud is not supporting our analysis. Why? Because for price to get to the first resistance, it needs to break our cloud before it can reverse. So whenever price breaks the cloud, it means that it's a buy already. If price breaks the Ichimoku cloud to the upside, it means it is a buy. Okay, so right now we have looked at two indicators and two indicators are not supporting our analysis. Let's see if RSI, stochastics, MACD are supporting our analysis. Okay, for those who don't understand how to use these indicators, I'm so sorry I wouldn't be able to explain every indicator in detail today. Okay, because these are topic on its own. The only thing possibly agreeing is stochastics. Okay, because when price reaches this area and reverse the resistance, similarly on the stochastics, it will reach and we will be looking for a resistance as well. RSI should also be supporting. Okay, let me see, MACD, not saying much. If anything, MACD is suggesting that there is a lot of bullish pressure right now. Okay, so we have pulled out 5 indicators. 2 agree with us and 2 does not agree with us. Do we still take this trade? That is the question. Okay, you ask 5 people if the pink dress looks good on you. Sorry, you ask 4 people if the pink dress looks good on you. 2 people tell you, actually you ask 5. 2, your mom and your dad say, yes, the pink dress looks good on you. Your brother and your sister say, no, don't get the pink dress, it doesn't look good on you. And you ask your cousin say, I don't know, I don't have an opinion on this. Do you still get in for this? Do you still buy the pink dress? Do you still get in for this sell? Can you guys let me know in the chat box what you would do? Okay, no response. I'm assuming everyone is confused as well. Nobody knows. Should I get this pink red? I will hold it off. Okay. I think that is a form of discipline. I think that's a form of discipline. Okay, so there is a saying that I live off by. When you are unsure, stay out. Okay. When in doubt, stay out. Okay. But some traders will look at this and be like, there is still a chance that I might win this trade. So if you are a risk taker, right, and you don't mind taking that risk, you can still get in on this trade. Yep, you can still get in a trade, but get in at a smaller lot size. So for example, if you were going to risk 1% on the trade, for example, and now you look at this setup, it's an okay setup, but right now two indicators are not agreeing with me. Two indicators are agreeing with me, two indicators are not agreeing with me. Ichimoku Cloud is actually saying that it's a possible buy already. Okay, Bollinger Band is saying that it's a buy, but Stochastics and RSI is saying it's a sell. Okay, so I think there's still, if I listen to Stochastic and RSI, I do think that there's a good chance that it's a sell, right? So it's just, again, our job as trader is to look for probability and to collect information. After we collect information, we decide where the markets are going based on the information we are collecting. So based on the information we are collecting, it is a sell, but there's signs that it's a buy. Okay, there is some signs it's a buy, but I think there is more things telling me it's a sell. So if you were going to risk like 1%, let's say you were going to risk $1,000 for this trade. Now it's not so clear, it's not as confident. Instead, what you can do is risk 500 instead, risk 300 instead, risk less. So you can still get in on this trade. Sometimes I do still get in on not very high probability trades. Okay, sometimes I still get in it. But if you are going to get on in it with a smaller risk. Okay, risk less. So you can still get in, but risk less. Okay, so this is what we are looking at on the daily. On the daily, it kind of looks like it's a sell because of the bigger channel, because of the resistance, horizontal resistance, because of the three Fibonacci levels lining up in the same area. It kind of makes us feel, because of stochastics, because of RSI, it makes us feel that it's a possible sell. Okay, let's go to the 4 hours. Okay, let's go to the 4 hours and see, do we think it's a sell? Okay, if I am looking at the 4 hours, right? Because I'm now at the 4 hours and I'm zooming in. I won't think it's a sell anymore. Why? I would actually instead be getting in on a buy. Okay, why? Because I'm now looking at an even smaller area. Okay, let us get rid of all of this. Let's get rid of all of this. Okay, first things first. What am I seeing? The first thing I see is that this was initially a resistance. Price broke this resistance and went higher. What is this indicating? This is indicating to me that this is a buy, that there is bullish pressure right now. Okay, it has broken this horizontal resistance here, which is indicating bullish resistance. It makes me want to get in for a buy. On top of that, it has broken this tiny channel here, which is this downtrend. Okay, so when I am on the bigger time frame, I'm more biased of a sell, because there's a lot of things that I can't really see, because on the bigger time frame there is still a bigger descending channel, right? There was an even bigger descending channel. But when I go to the small time frame, that bigger descending channel is not relevant to me anymore because it is too far away. Remember, there was a descending channel that was lining up here. Okay, so on the 1 hour, it looks like it was closer to price, but on the 4 hours, it still looks like it's quite far away. So it's not that relevant for me. So instead, I can look for a buy. So you can see how on different time frames, on the same charts for BTC USD, on different time frames will tell you different things. Okay, on the bigger time frame, I might be biased for a sell, but on the smaller time frame, I will be biased for a buy. Why? Because it is short-term buy, long-term sell. Okay, so I can just play that buy to that sell area to the bigger time frame, and then I can sell from there. In plotting support resistance, how many touches? Support resistance, minimally 1. Honestly, just 1. Horizontal support resistance, you need just 1. But of course, the more touches, the better. The more touches just means that that is a very relevant support and resistance. I don't understand why we're not using the bigger channel. Okay, why? Because when I go on the daily time frame, okay, if I go on the daily time frame, guys, we're actually running out of time, so I hope for those who don't mind, you can stay on if you want. I can just do another 10 minutes or 5 to 10 minutes maybe. Okay, on the bigger time frame, this channel looks very relevant. Okay, look, it's still like, it looks very relevant. It looks like price is approaching, okay, our channel. But if we go to the smaller time frame, we go to the 4 hours, or even if we go to the 1 hour, maybe on the 1 hour would be even better. Do you see how far that channel is? On the 1 hour, I'm only looking at this small little area here, for example. Okay, I'm only looking for this area. On the 4 hours, I'm only looking at this small little area. It's that area that I'm focusing on the smaller time frame is this small area, but the channel is here. It's this big area here. So it's so far away from my focus point or my view that it is not relevant to me at this current point of time. You understand? But if I go to the daily, the channel, I can still see the channel, right? I can nicely see the channel. I can see the structure of the channel. But when I go to the 4 hours, because on the daily, I'm focusing on this area. But on the 4 hours, if I focus on that area, that's too big of an area. We want to focus on small areas. When I'm on the 4 hours, instead, I should be focusing on this area. When I'm on the 1 hour, I should be focusing on this area. Okay, so the time frame that you're looking at, you should be focusing on that area that is at least still in the screen, right? On the 4 hours, if I were to use that big channel, I would need to zoom out a lot. I need to zoom out a lot. Zoom out. Do you see how small my candlesticks are? My candlesticks are so small. It's gonna be very hard to chart on this. Okay, so you're using a small time frame to refine your strategy. Okay, so in this case, this big channel, we can leave it there as reference, but honestly, it's not that much relevant when we're looking for entry. Okay, so when we're going to smaller time frames, we're using the smaller time frames to look for our entry, to look for a better entry. It can work as a very good take profit area. Okay, we can use this area here as a take profit area, but when we're looking for entry, honestly, this channel is not relevant to us. Okay, this channel is not relevant to us. Okay, so let's try to find a more relevant entry. Now, instead of looking for a sell, we are looking for a buy already, because we are focusing on this area here. Okay, and when we focus on this area, what does it look like? It looks like it's going up. It is making higher highs and higher lows. Okay, it's making higher highs and higher lows. There's a higher structure, whereas when we were on the daily, it looks like it was on a downtrend. Okay, but now that we're on a 4 hours, it looks like it's on a uptrend. Okay, so we can be looking for a buy entry on the 4 hours. Let me get rid of all of this so that it's clearer. Okay, we can be looking for buy entry. So usually the buy entry I want to look for is the pullback to this area. It pulls back and retests this area, and I get in for a buy. Where do I buy it to? I buy it, that's actually too far. You see on the daily, if we're using the information on the daily for the 4 hours, it's actually too far. There is actually a closer resistance here. This is a much closer resistance here. Okay, this is your resistance. I'm going to put it as second resistance because it is another door, but that door is behind this door instead. Okay, so if we are getting in for a buy, I think on the minimal, it should come to this first resistance first. Okay, Do you guys see how different time frames on the same pair will be giving you different analysis and different charts, right? So based on this, I am getting in on a buy from here to here. That information we collected on the daily is not even relevant on the 4 hours. It's not even that relevant on the 4 hours, right? We can leave that there for reference, okay? We can leave that there for reference, but honestly, it's not relevant. I can get rid of all of this and it does nothing for our current analysis. Okay, so think it is a short-term buy, at least to this area. Whatever happens from here, we need to wait for price to get here to decide again. Why do I think it's a buy? Because of the channel breakout, because of the horizontal level breakout. I think that's a good entry. That's a good area for entry. Why? It lines up nicely with the horizontal pullback area here. We've got a horizontal pullback area here. It lines up nicely with the 23.6 Fibonacci retracement. So I'm hoping that price does this pullback. When it gets here, wait for a reversal candlestick pattern. I cannot go through that with you today. Just type reversal pattern candlesticks in Google and look for reversal pattern candlesticks. Okay, so these are some of the examples. We've got bearish engulfing, bearish tweezer, bullish engulfing, bullish tweezer, dojis, evening star, hammer. Okay, when price comes back to this first support, you need to see a reversal pattern candlesticks that confirms the buy. Okay, that confirms the buy. You see that, you are good for the buy. If that does not appear, do not get in for the buy. Okay, again, back to the pink dress story. Your job as a trader is only to collect information and then decide if the information is good enough to make your decision. Okay, so you want to ask as many people as possible if your pink dress is nice. So you're asking your dad, your mom, your grandma, your cousin, your blah blah blah. Waiting for the reversal candlesticks pattern is basically waiting for another form of confirmation. Okay, that is another form of confirmation. If the reversal pattern candlestick appears here, it is a confirmation for a yes that you are good for the buy. Okay, so wait for the pullback, wait for the reversal candlestick pattern, and then you are good to enter for a buy. Why? Because of the channel breakout, because of the horizontal breakout, and because price is moving above the Ichimoku cloud. Okay, so we've got a few reasons to believe that this is a buy. Okay, but we need to wait for price to come here and then we get in for our buy. Why do we wait for price to come here and why do we not just get in for the buy right now? Because getting in for the buy right now, right? Let me show you, okay? The difference with waiting for price to come back to your first support and getting in for a buy is your risk to reward. So I don't know if you guys have heard this saying. It was said by Warren Buffett. Robert Kiyosaki. Robert Kiyosaki said that you should be winning from entry onwards. The win should start from your entry onwards. Okay, so your entry, imagine you got in from here. Right now, you get in for this buy. Although I do think it will go to the first resistance. Okay, you get in right now. If you get in right now, your risk to reward for this trade is, sorry, let me pull this, 1 to 2. That means if you have a $100,000 account, it's not even 1 to 2. Let me properly adjust. If you get in right now, okay, it's 1 to 123. 1 to 1.22. It means if you get in right now, if you have a $100,000 account, you are risking 1%, right? You risk 1%, so you risk $1,000. If price goes to your stop loss, you lose $1,000. If price goes to your take profit, you win $1,230. If you get in now, that's your risk to reward. But sorry, let's say your take profit is here. Sorry, that's not even your proper risk to reward. Okay, let's say your stop loss. Let's say your stop loss is here. Okay, because you need to put a stop loss, right? Let's say your stop loss is here. Your risk to reward is actually 0.79. Okay, if you get in here right now, you put your stop loss here below the first support, it's 0.79. You are risking $1,000 to make $790. That does not make sense. The risk to reward does not make sense. You are risking more to make less. But if you wait, you patiently wait for price to come back to your first support, you patiently wait for the reversal pattern candlesticks. This is your entry. now your trade immediately becomes 1 to 3.7. That means if you lose, price goes to this stop loss here, you lose $1,000. But if you win $3,700 because the risk to reward is 1 to 3.7. Okay, so risk to reward is very, very super crucial in trading. Okay, it means that you are risking very little to win a lot. Okay, so we should be taking this kind of trades rather than risking a lot to make very little. I know for some of the new traders here, you may be experiencing it. When you see your trades in the win, you take profit prematurely, you make very little, but when you see it at a loss, you don't close it, right? I'm sure there's a lot of you, some of you here who do that, because when I started trading, that was me as well. When I'm losing, I will never close my trade. But when I'm winning just even a bit, I will take the trade. But if you think about it, why are you doing that to yourself? That means that if you lose big, but when you win very little. At the end of the day, you're going to lose, right? At the end of the day, you are going to lose. So you should be taking less risk, more profit. Less risk, more profit. Less risk, more profit. So patiently wait for price to come back to the first support. If it doesn't come back to the first support, just take it that you missed the trade, okay? Don't chase the trade. Just take it that you missed the trade. Move on, look for another trade. Okay, that's all I have for you guys today. Thanks for joining. I will see you guys again next week probably, right? Thanks Jesse for being so interactive, right? Thanks Patrick, thanks Miguel, Abe. I'm sorry if I'm not pronouncing your first name, I'm just pronouncing whichever name I can pronounce. Thanks Emerson, thanks Kingsley, the other Kingsley, thanks Phoebe, thanks Hans, thanks Osta, Isaiah, Jesse, Kingsley Israel, Mark, Michael, Patrick, Shahid, Simon, Joash, Josh, Williams, Tuan. Some of you have already left. Thanks so much. I will catch you guys again next week. Bye guys.
Hi everyone, Emily here. Today I will be talking to you about some crucial trading tips. 3 important qualities traders tend to ignore. Your personal life should complement your trading career. In other words, if your personal life is a mess, how can your trading be at a top level? You have to protect your personal life and keep your mind clean from outside interfering, as this could affect your trading. Second, you have to enjoy the ride. A successful trader knows how to enjoy his life on the rainy days and on the profitable days. That means if you reach an objective, let's say a profit target, do something for yourself or celebrate. If you failed, move on. Third and final, you must have a balance between your personal life and your trading career. Some traders think that by spending 16 hours per day in front of the screen or doing research, they will be successful. That is a no-no. You have trade, but you should also spend times with your kids, your wife, your family, your friends. So make sure you're chasing the right things. It may sound hard to trade and keep a full-time job at the same time, yet a number of part-time traders proved that this is doable and actually may prove quite profitable. We have a couple of tips for such a trading. First, be organized and disciplined. Make a plan. Target specific events. Have your technical and fundamental analysis well before the event takes place and stick to your plan. Don't forget to keep it sweet and simple. Secondly, use the technology given. Use the stop loss, take profit levels as well as pending orders and incorporate them in your trading. They tend to take lots of pressure off of you. The same applies for alerts, which inform you instantly when a particular trading instrument has crossed a particular level. I know it takes time to master this, but believe me, they are worth every minute of the time and effort spent. Thank you so much.
Once you have chosen your preferred trading instrument, the next thing will be to set up a plan. You will need to do a technical and fundamental analysis to understand the circumstances surrounding your trading, and then decide at what moment you enter the market, on what direction and which volume you are setting your trade. Also, you will have to define at which price you enter and at which you exit the market. There is no such thing as the perfect entry and exit. Stick only to the entry and exit parameters in your plan. Harness the technology available. Set automatic stop loss and take profit orders. Try to set the emotions of greed and fear under control, but have no misconception and emotionless trading cannot endure, so be conscious about your trading. Maintain discipline and your bottom line will thank you for the long run. I can tell you, I see so many people on YouTube, on blogs, on social media trying to make videos to show people how to trade. The first thing you need to know about trading is that it has to express your uniqueness. The best traders in the world are the best because they know who they are original, they are confident in their ideas, and they're more than confident to display their uniqueness through their trading.